So the market sent a few mixed signals today in terms of the economic data that has a few people scratching their heads in wonderment. We had consumer confidence move back up to a new post-recession high. Folks are feeling very good about their current situation, and yet we've had the second consecutive month of month-over-month declines in house prices as the housing market seems to be hitting a little bit of a soft patch. If you dig into the consumer confidence numbers, it shows that folks are feeling very good about their current situation. So we've seen some very strong job numbers this summer. The stock market's been performing very well, pushing to new record highs. And yet their future expectations of both jobs and income have been relatively flat. In fact, they declined last month slightly. So that could be holding some folks back from making big purchases such as a house or possibly a new car. And that could be explaining some of the weakness we've seen in home prices. The good news is that there's evidence that the housing market, while it's suffering a little bit of a soft patch right now, is going to move back into strength later on this year. As long as the economic data continues to be strong, as long as the job market continues to be strong, this apprehension that consumers are having about the future should diminish. And in combination, we should see a tightening of this housing supply, and that should in turn translate into a rebound in home prices and possibly a reacceleration to the upside, which will be good news for homeowners, and then in turn should support further confidence in consumers as higher home equity encourages them to go out and boost retail spending. And going forward. Now, it's important to remember that on a year-over-year annual basis, home prices are still moving up. They're just moving up at a slower rate than they had in the recent past. Now, one point to keep an eye on is the amount of supply in the market, which is measured by months of sales. So this is a good way to keep an eye on how many available homes are out there, and that also gives us an indication of where prices should be going forward. Now, this month we've seen a slight decrease in the amount of inventory out there. So So the final piece to the puzzle here that we've been waiting really years for has been a big takeoff in home prices that could possibly return us back to the peak levels we saw in 2006 and 2007. And the final piece of that puzzle is wages. So we've had job gains reaccelerating. In fact, we're looking at the best pace of job creation since the 1990s, but we haven't seen yet a significant acceleration of wage gains. As long as the job gains continue to be steady, and the economy takes no large hits, we should finally, wages are a lagging indicator that's kind of the last thing in an economic cycle to turn higher. So as long as everything continues on its current path, we should see wages turn higher, and with interest rates still very low, The combination of relatively cheap and abundant credit with lending standards actually loosening up, the combination of that with higher wages should really provide a significant lift to home prices and possibly get us back to those 2006 levels that everybody's been waiting for.